This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the fourth lecture on foreign exchange risk management. And I did say there are two methods of hedging the foreign exchange risk, the transaction risk, that you can be expected to do numbers on. One was the use of forward contracts, forward rates, which we dealt with in the previous lecture. In this lecture, the other one, money market hedging. And to show you what it is and how we do it, look at example 6, if you would. P is due to receive $5 million in 3 months' time. And again, we're in the UK, and so it will need converting into pounds. We know what today's spot rate is, but there's no mention of any forward rate. So how can we hedge the risk? There's no forward rate available. And if we do nothing, then we're at risk, because obviously the exchange rate in 3 months' time could be anything. It might be higher, it might be lower. The only thing we're certain of is today's spot rate. So if I was converting today, then of course there's no risk. The future movement would be irrelevant. But how can I convert today when we're not going to get the money for 3 months? So what we're going to do is this. We're going to borrow dollars now. I'm going to borrow dollars now. Okay, we're going to get 5 million in 3 months. So in 3 months' time, I'll be able to repay my borrowing. And we'll put the numbers in a minute, I'll leave blanks. But the reason I'll borrow dollars now is that then I'm in a position to convert now at spot. And there'll be no risk. Now, the only thing, of course, is I'll then be getting pounds now when I wasn't expecting to get money for 3 months. Well, we could just keep the pounds now, but to make it comparable, we say, well, we won't take the pounds now, we'll deposit the pounds for 3 months. And that's why they've given us interest rates. And it says the current 3-month interest rates in the US, interest rates are 5.2 to 5.8%. In the UK, ignore the word LIBOR, that's irrelevant, but in the UK, interest rates are 3.6 to 3.9. Now, why have they given two rates? Well, the reason two rates are quoted is depending on whether you're borrowing or depositing. And I think it's obvious which is which. If it's dollars we're talking about, the US, surely if you're depositing money, the banks will pay you the lower rate of 5.2%. If you're borrowing money, the banks will charge you the higher rate. So I don't need to write that down. You'll always pay the higher rate of interest if you're borrowing. You'll receive the lower rate if you're depositing. Well, we're talking about borrowing dollars now. And so the relevant rate for borrowing is 5.8%. However, one other thing, interest rates are always quoted as annual rates. And they do in real life. You know, if you look at your bank and see what rate of interest they're charging or they're giving, they'll always quote it as an annual rate, but the rate they quote will be different depending on how long you're borrowing or depositing for. So here, if you're borrowing for 3 months, they will charge at the rate of 5.8% a year. If you're borrowing for 6 months, they'll charge a different rate. They might charge 6% a year. So the rates given are always yearly rates. We're only going to be borrowing for 3 months. And so the actual interest we'll pay will be 3/12 of that. So we'll borrow dollars at, the actual interest we'll pay is 1.45%. Well, how many dollars can I afford to borrow? We're going to receive $5 million in 3 months, and I'll use that to repay the borrowing. But of course, think about it. If I borrow $5 million now, in 3 months' time, I'll owe more because of interest, and I won't have enough to repay it. So we say, well, how much can I afford to borrow? If I was to borrow X now, then how much would I owe in 3 months? They'll add on 1.45% interest, so I'd owe X times 1.0145. And I want to make sure that the $5 million we receive will exactly repay that borrowing. And so I'll borrow a bit less than $5 million. How much will I borrow? X, it'll be 5 million divided by 1.0145. So the amount I'll borrow, 5 million divided by 1.0145, which means I'll borrow $492,853.36. So there's step 1. I'm going to borrow that much now, 4.9 million. And in 3 months' time, they'll have added on interest. I'll be owing exactly 5 million. And when we get the 5 million from the customer, it'll repay that borrowing. Why have I borrowed it now? Because since I've now got dollars today, I can convert at today's spot rate. So 492,853.36. The spot rate today, well, 5384 to 5426. Which rate am I going to use? What's happening? We've got dollars, so I'm going to sell dollars to convert into pounds. The dollar sell rate, 1.5426. Which gives me how many pounds now? 492,853.36 divided by 1.5426 is 319,4954 pounds now. Finally, as I said earlier, we've got £3 million now, and we could just stop there and take it. But just to make things comparable, instead of taking the money now, because we weren't expecting any money until 3 months from now, we'll deposit it for 3 months in the UK. And what will be the interest rate? The lower of the two, which is 3.6%. But again, it's a yearly rate. We're only actually going to be depositing for 3 months. 3/12 of that is 0.9%. So how much will our pounds have grown to? 319,4954. To add on 1%, you multiply by 1.01. To add on 0.9 of 1%, 1.009. Means it'll have grown to 319,4954 times 1.009, 3223709. and that amount is fixed in 3 months' time. And it doesn't matter what happens to the exchange rate. And do be clear I know it's a bit messy this, the first time you see it, but be clear what will happen in 3 months' time. Two things happen. We receive the money from the customer, and that will go straight to repaying the borrowing. In 3 months' time, we'll owe 5 million. So when the customer's money comes in, straight to the repay. Second thing that happens, though, in 3 months' time, our pound deposit matures. And so what happens then? We receive 3223,709. And so the end result is just like having used a forward rate. It was messier, but by arranging that borrowing at fixed interest, by arranging that deposit at fixed interest, by converting today, the end result, there's no net cash flow now. You borrow money, convert deposit money, so there's no net cash flow. In cash flow terms, 3 months' time, the customer pays 5 million. We receive a fixed 3 point whatever million. And before I look at example 2, and this is quite important, this is effectively the same as forward rates. You see, in the old days, this was all that was available. Banks, you could always borrow and deposit in foreign currencies, so that was always available. But there are charges and things involved, and it's only realistic to do that on big amounts of money. Me with 1,000, it's not worth going through all that hassle just for 1,000. And so the banks started to offer a service where they would quote you forward rates, but all they were doing, they've got lots of people wanting to commit to exchange in 1 month's time, 2 months' time, 3 months' time, and so on. So they've got lots of people doing it. What they do is put all the money together. They use money market hedging on the money. But they, instead of you personally having to arrange it all, they just quote you a forward rate. All right, they obviously have charges involved. They've got to make money out of it. But the banks are doing money market hedging on your money when they quote a forward rate. And because of that, the forward rate isn't the bank's guess at what the exchange rate will be. Not at all. They're doing this arithmetic. The forward rate is determined by the two interest rates. And if you look on the formula sheet, and I did mention it in an earlier chapter, you'll see, if I can find my formula sheet, there's a formula right at the bottom of the page. Where is it? I've lost my formula sheet. But right at the bottom of the page, you've got a formula for purchasing power parity, which we explained. S1 equals S0 times blah, blah, blah. But there's also the interest rate parity formula. F equals S times whatever, 1 plus one interest rate or 1 plus the other. It's exactly the same formula, but it's the interest rates determine the forward rate. All right, anyway, that's money market hedging. As I say, it is messy. You may have to have a look back, But for completeness, I better show you example 7. Example 6 was where you're receiving money. So we borrow, then we can convert and then deposit. Example 7 is when you're paying money. So, same idea, but think about this very carefully. We're going to be paying money. And so what I'm going to do, I want to convert now. I want to buy dollars now, so we can convert at today's rate. But how can I buy dollars now without my money? What I'll do is I'll borrow pounds now for 3 months, because I don't want to pay the money any earlier. You know, we're not due to pay until 3 months. So rather than have to pay early, I'll borrow some pounds now for 3 months. We'll convert to dollars now. I've got dollars now, but I don't want to pay the customer early. So we'll then deposit the dollars for 3 months. And then in 3 months' time, I'll use the deposit to pay the customer. What the interest rate's going to be? Well, if I'm borrowing pounds, the UK rate for borrowing is 9.9%. But again, it's a yearly rate. We're only borrowing for 3 months. So we'll actually pay 2.475%. Later, we're going to deposit dollars for 3 months. Well, the interest for depositing is 6.4%, but as I've kept saying, that's the yearly rate. If we're depositing for 3 months, it'll simply be 3/12. That'll be the interest we get. 6.4 divided by 3/12, or multiplied by 3/12, 1.6%. Now let's put figures to it. Now we're going to have to work backwards because I don't know how many pounds I'm going to need to borrow until I know how many dollars I'll have to put on deposit. You see, I want to be able to deposit enough dollars such that it will grow after 3 months to the 8 million I need. We need 8 million in 3 months' time. I'm going to be earning interest, so we'll only need to deposit a little bit less. So a bit like before, if I divide by 1.016, the amount we need to deposit, 8 million, divided by 1.016, 7874016. If I deposit 7.8 million now, with interest added on of 1.6%, then in 3 months' time, I'll have the 8 million that we need to pay the customer. So I'll deposit that much now. Well, I need to get $7.8 million now, so we'll convert today. And at what rate will we convert? 7874016. Well, don't forget, in order to be able to put $7.8 million on deposit, I'll need to buy $7.8 million, and therefore we'll convert at the buy rate 1.6201. So how many pounds do I need? $7874016. 7874016 divided by 1.6201, 4860 204. Finally, in order to have that 4.86, we're going to need to borrow it. We'll borrow it for 3 months, and so by the end of 3 months, they'll have added on interest. We'll be owing more. And so 486.0204. It's borrowed at 2.475%. So the amount owing in 3 months' time, add on the interest, multiply by 1.02475. And we'll be owing, what does it come to? £498.0494. That's how much we'll be owing in 3 months' time. And so that's what's going to happen. I'll borrow 4.86 million now. I'll convert it to dollars now and get $7.87 million. And then I'll put those dollars on deposit, and in 3 months' time, it'll have grown to 8 million. And do be clear of the net effect. As of today, there is no net cash flow. We borrow, convert, deposit. The net cash flow today is 0. But in 3 months' time, 2 things happen. First of all, the dollar deposit matures. And 8 million appears, and that goes straight to the customer. Sorry, to the supplier. We're paying money, I beg your pardon. That goes straight to the supplier. The other thing that happens in 3 months' time is I need to repay the pound borrowing. And so how much do we pay? 498.0494. And so there's the cash flow. In 3 months' time, I pay 4.9 million. The customer receives 8 million. The amounts are all fixed. It's irrelevant what happens to the exchange rate. So again, the same net effect as using forward rates. In fact, this is equivalent to a forward rate of what? $8 million is what we get for 4.98 million pounds. And so it's equal to a forward rate of 8 million over 4.980494, which is $1.6063. It's exactly the same. In either case, we've got a fixed amount in 3 months. It's irrelevant what happens to the spot exchange rate. And in practice, money market hedging would be better when it's big amounts of money, because the costs involved would be lower. For small amounts of money, it's going to be cheaper and easier just to go to the bank and get a forward rate. But ignoring the charges involved, which we do in the exam, the two are sort of identical. All right, so do spend time going back through that, because again, forward contracts you should find very easy indeed. Money market hedging clearly does need more thought. Once you've got it, it's okay, but it does obviously take that bit of time. All right, there is going to be one more lecture where I'll run through the other methods of hedging. But again, the other methods, you cannot be asked numbers on. It's just being aware what we mean by futures, options, swaps.